Hi, this is Merrill with Tax Tutor. There are really three different ways to save money on taxes. I often call them the big three. There's entity selection, tax deductions, and tax strategies. Today, I would like to talk about entity selection and get really deep into the different types of entities and what those entities mean for taxes. So first off, we have to talk about what these entities are. Now, when you set up an entity, a lot of people think that you would go like to the IRS and set up an entity, but that's not the case at all. The IRS has nothing to do with business entities other than once they're set up, you'll go to the IRS and get like an employer identification number, which is often called an EIN. The entity is actually set up at the state level. So you can either set that up in the state that you live in, the state that you're doing business in, if that's different than the state you live in, or you could just set it up in a different state altogether. Some people think that the state that they set it up in, their entity in, has to do with how they are taxed. For example, Nevada does not have an income tax. So a lot of people have the misconception that even though they live in, say, California, that if they set up their business in Nevada, their entity in Nevada as a legal entity there, that somehow they won't have to pay California tax. Unfortunately, that's not true. That's not how it works. If you live in California and you work in California, even though your entity is set up and registered in Nevada, that makes zero difference for taxes. If you're living and working and doing all the work in California, all of your income is going to be taxed in California. The only reason why you would set up an entity in another state is because perhaps another state would give you a better legal protections than another state, one state or another. So that's kind of beyond the realm of Tax Tutor and what we do here and me as a CPA. That gets into the legal side. So if you're wondering legally the best state to set up an entity, that would be an attorney or someone we need to talk to and address that. But in terms of tax side, we can talk a lot about entities. So again, it doesn't matter which state you really set it up for taxes, it just matters where you live and where you're doing that business. Now, when you go down to the state and you set up an entity, there are three different types of entities you can set up. There kind of is a fourth entity. It's not really required, so we'll start off with that one. It's the most basic way of doing business, and that is called a sole proprietor. Now, a sole proprietor is not really a legal entity at all. A sole proprietor is just an individual that's doing business, or really it's an individual that's making money and not being paid as an employee. So an example here is my sister. When she was in high school, she did tutoring for a family down the street. That family decided to pay her for her tutoring services. So she got this pay, and that is a sole proprietor. She doesn't have an LLC, she's not registered with state, she doesn't have a business name. None of that matters. This family was not giving her a W-2 for the work that she was performing. They just gave her a check, paid her that way. Now, it's important to note in this context, they weren't required to 1099 her because 1099s are only required if you're doing them as part of a business transaction. You don't 1099 somebody for a personal transaction. For example, if you've got a plumbing issue at your home and you have a plumber come and that plumber charges you, say, $1,000, you don't 1099 that plumber because you're not paying that plumber as part of your business. So in this instance, my sister did not receive a 1099. She was just paid. That makes her a sole proprietor. Legally, she's required to report that income on a tax return, and we did. We reported it on a Schedule C of her tax return, reported her income. You can also report your expenses. Some people think that you have to have an LLC in order to get a better tax result. The reality is it doesn't matter. Like in this case, had my sister had an LLC or not had an LLC, the result was the exact same. It mattered nothing at all that she didn't have an LLC. The only thing an LLC does is gives you some liability protections, and we'll get more into that in this video. But anyway, sole proprietor, simplest form of doing business. You don't have to register anything with the state, don't have to set up a name, anything like that. You're just in business. You can still deduct all of your expenses. There's no law against deducting expenses if you have the Schedule C income. So you report the income and expenses there. So that's the simplest form. Then we get into the actual legal entities that you can set up at the state. There are 3 legal entities like we mentioned. There's a partnership. So when you go to the state and you set up a partnership, you can set up either a general partnership or a limited partnership. A general partnership means that all the partners take on the liability of that partnership. So you don't have a limited liability of anybody. Everybody's basically saying, yes, we're a general partnership. Anything goes wrong in this partnership, you can hold me legally liable for. Then there's also a limited partnership that you can set up with the state. Now, when you hear the name limited partnership, you might think, oh, that's great. You set up one of those, everybody has limited liability. That's actually not how it works. A limited partnership means just at least one of the partners has limited liability. It's usually a partner that's not directly involved. Maybe it's a silent partner or somebody that's invested into that partnership and they're not actually working inside that partnership. They're limited, and so their liability is limited. Inside of a limited partnership, at least one partner still has to be a general partner. So at least one person has to be willing to raise their hand and say, if anything goes bad, send it all to me. I'm willing to take on all liability of that partnership. So from a liability standpoint, partnerships aren't really great because either everybody's still legally liable or at least one person's legally liable, and nobody really wants that. And so states came up with a way to limit the liability of owners, and that was through corporations. So that's the next entity you can go to the state. You can set up a partnership or you can set up a corporation. So you just go down to the state and then you'd have a name and set it up, and it'd usually be called Corp or Inc. or something along those lines would be included in the name. And then the last entity, the type of entity you can set up, is the most common, and that entity is an LLC, a limited liability company. Now we have a company that's not a corporation but still gives all of its owners, all of its members, limited liability. And that has become the most popular form of doing business now for reasons that we'll get into here in a moment. So those are our legal entities, basically sole proprietor, partnership, corporation, and LLC. Now, when it comes to being taxed, you set those type of entities up at the state, then the IRS recognizes each of those entities differently for tax purposes. So first off, the simple one, if you're a sole proprietor, meaning you really haven't set up anything at the state, or maybe you've registered a name. Sometimes a sole proprietor has like a DBA, a doing business as, with the state. Then that's taxed as a sole proprietor. And we'll get into how that's taxed and how that looks like in a moment. But you're taxed as a sole proprietor. If you go down to the state and you set up a partnership, then you are taxed as a partnership and you fall under all of the partnership rules inside of the tax code. Now, if you go down to the state and you set up a corporation, well, now we've got something different happening here. Because if you just go down to the state and you set up a corporation, for tax purposes, you're treated as a C corporation. And C corporations are not the greatest. We'll get into more of it in a moment here, but C corporations are subject to double tax, and there's kind of other issues with C corporations. So in order to avoid being double taxed, the IRS says that, okay, if you go to the state and you set up a corporation, but you don't want to be taxed as a corporation, you want to be taxed as, let's say, an S corporation, then we'll allow corporations to make an election with the IRS to be treated as an S-corp. Now, as we talked about the legal liabilities that you set up with the state, we said that one of those was a corporation. We didn't say it was a C corporation or an S corporation. Those terms don't really exist at the state level. So you can't go down to your state and say, hey, I want to form an S corporation. They wouldn't know what to do. That there's no such thing as an S corporation on the state level. An S corporation only exists for tax purposes. And an S corporation is set up by forming a corporation with the state and then making what's called an S election You file a Form 2553 and you make an S election there with the state. Now, if you're paying attention, there's one entity that we haven't talked about, that we haven't addressed yet, and that is the LLC. So LLCs are really kind of interesting when it comes to taxes because they haven't been around for that long. Sole proprietors, partnerships, and corporations, C-corps and S-corps, have been around for many, many, many years. There's entire sections of tax code written for each of those entities that's been around for decades, for a very long time. And then LLCs came around. LLCs were actually invented or created by the state of Wyoming in kind of the late 70s, somewhere around 1978, 1977, somewhere around there. Wyoming came up with LLCs. And they said, okay, we're going to come up with an LLC. It's a limited liability company. All the members have limited liability, and this is how we're going to operate. And then it went to the IRS and said, okay, IRS, how are you going to treat this new entity? And the IRS looked at it and said, oh, we really don't know how to treat this entity. Let us think about that for a bit. And so the IRS went and thought about it, and it took them about a decade, took them about 10 years of thinking about it to figure out what to do. And they finally said, okay, well, as we think through this, what can we do? We can either write all new tax code for LLCs and have their own tax code, just like partnerships and S-corps and C-corps have their own. Maybe we make a tax code for LLCs. Or they said, or you know what, we can take these LLCs and we can find a way to make them work with the current tax code and just fit in. So we don't have to write any new laws. We'll just make LLCs fit what is in the code. And that's what they decided to do. They decided to make LLCs fit the current tax code. So, what they did is they said, okay, if you have an LLC and that's owned 100% by an individual, we're going to treat that like a sole proprietor. So it's going to fall under the sole proprietor section of the Internal Revenue Code. All of the rules that relate to sole proprietors are going to apply to that LLC. There'll be liability protection because it's an LLC, but for tax purposes, we don't even recognize it. The IRS calls that a disregarded entity because the IRS disregards it. They don't even see an entity. They see the individual that owns it. For legal purposes, there's an entity there that protects you legally, but for tax purposes, there's nothing there. It's basically you. And then the IRS said, okay, if it's owned by more than one person, it can't be a sole proprietor because a sole proprietor is only owned by one person. So if it's owned by more than one person, we're going to treat that like a partnership. So if you go down to the state, you form an LLC, and it's owned by more than one person, the tax code treats that like a partnership and would file a partnership return, and it falls under all of the partnership rules and regulations of the Internal Revenue Code. Then, for some reason, the IRS went even further, and they said, okay, if you have an LLC and you want this LLC to be treated like a C corporation, then file an election and we'll treat the LLC like a C corporation. And it will fall under all the C corporation laws and rules and file a C corporation tax return, and it will pay double tax like C corporations do. And then it said, okay, and then if you want your LLC to be treated like an S corporation, then you can file an election to be treated like an S corporation, and it will fall under all the rules and regulations of S corporations and be treated like an S corp and file an S corporation return. So when somebody comes to me and I say, okay, you're doing business, that's great, things are going well for you, what kind of entity do you have? And they say, I have an LLC. I say, well, that's great, but it doesn't mean anything to me because an LLC, for tax purposes, doesn't really exist. There's no such thing as an LLC for tax purposes. That LLC is either a sole proprietor, a partnership, an S corporation, or a C corporation. There is no such thing as a LLC tax return. There's no form for an LLC to file. It's got to file as one of those four entity types. So now as we get into how these entities file. So let's talk about sole proprietors. So sole proprietor is the simplest form of doing business. Again, there's no liability protection because a sole proprietor doesn't have an entity formed unless it has an LLC that's owned 100% by an individual. Then that LLC is treated like a sole proprietor but has liability protections. And that sole proprietor will file a Schedule C with the 1040. The Schedule C is the simplest form to file. It simply reports income and expenses. It's a 2-page form. It's included on the 1040. You don't have to file a separate tax return. So you just report income and expenses on there. There's some questions that are answered, but it's fairly basic and a simple form to file with the IRS. Then if you have a partnership, either you go to the state and you form a partnership, or you go to the state and form an LLC that's owned by more than one person and thereby forms a partnership. Now you file a 1065. You still have liability protection, especially if you're an LLC, then everybody has limited liability protection. The 1065 is a much more substantial form than the Schedule C. The 1065 has multiple pages that go with it. There are pages of questions that need to be answered. You put your income and expenses. You have to report a balance sheet on there if your income's above certain thresholds or you have a certain amount of assets. Then a partnership return, since it has more than one partner, it has to allocate income to each of those partners. So there's a form that is called a K1. That K1 basically takes all the partnership income and divides it out to a partner. So let's say that you and a family member, say a brother or something, own a partnership 50-50. The partnership tax return, the 1065, is going to take 100% of that income, all of the income, all the expenses, and then it's going to come to a net number, and then it's going to divide that income 50-50 between you and that other partner that's in there, and you will each get a K1 so that you report your income on your personal return. So a partnership is a flow-through entity, which means anything that happens at that partnership level automatically flows through to the owners of that partnership. So if you own 50% of that partnership and that partnership makes, say, $100,000 during the year, you're going to get allocated $50,000 of income that you report on your return. And that happens regardless of whether you actually got $50,000 in cash. That's how flow-through entities work. The partnership might hold on to that cash and say, we need it to grow, but there's no deduction for that, and so you actually get taxed on $50,000 regardless of whether you get the money or not, which is kind of a tough part of owning a flow-through entity. S-corporations are similar in that sort of way. So if you have an S-corporation, you would file an s-corp return, which is a Form 1120-S. And again, it's a flow-through entity, so anything that happens inside that S-corp flows directly to the owners regardless of whether they got the cash or not. An S-corporation doesn't have to be owned by multiple people. So if you had an LLC that you own 100% yourself and you wanted to treat it as an S-corporation, you can make an election and you would file an S-corp and it would just have one owner. A partnership can't have just one owner because it's called a partnership. A partnership implies there's more than one person. There's people that are partnering together in a business. But an S-corporation can have only one owner. Now, the biggest difference between an S-corporation and the other entities, between a sole proprietor and a partnership, is employment taxes. So a sole proprietor and a partnership are both subject to both income tax and employment taxes. So if you make, say, $100,000 as a sole proprietor, you pay income tax, federal and state. If you live in a state that assesses income tax, you'll pay income tax, and you'll pay employment taxes. And depending on your employment income, that employment tax can be as much as 15.3%. So let's say that you have a sole proprietor, that's your only income is $100,000 as a sole proprietor. You'll pay income tax on that, usually around 12% or more, depending on your filing status. But then you'll also be assessed 15.3% employment taxes. So that's $15,000 of employment taxes that you'll be assessed on that income. Same thing as a partnership. Let's say that you have a partnership that makes $100,000. You get a K1 from a partnership that shows $100,000 of income. You're going to pay income tax as well as employment taxes on that income if you're active in that partnership and work at generating that income. Now, when it comes to an S-corporation, S-corporations are the exception to the employment tax because S-corporations are not, the income is not subject to employment tax. So if you get a K1 from an S-corporation for $100,000, you put that on your personal return, you will only pay income tax. You will not pay employment taxes on that. Now, the IRS looked at this and said, okay, S-corps don't pay employment tax, but we can't have people not paying employment taxes. Like they need to be paying into the system, doing the FICA and all that sort of stuff. And so they said, okay, when you own an S corporation, you're not subject to employment taxes. However, S-corp owners are required to take out a reasonable salary. So if you set up an S corporation, you also have to set up payroll. You have to put yourself up on payroll, take payroll during the year, and then get a W-2, and that W-2 income will be subject to employment taxes. Well, that's all fine. That actually gives us a lot of planning opportunities because in the S corporation, you are only required to take out what's called a reasonable salary. And that is what you would reasonably pay someone to do your job, to do the work that you are performing. So let's say that your S-corp makes $100,000 and your reasonable salary is $50,000. So what you would do in that case is S-corp makes $100,000. $50,000 of that is paid out in W-2 salary. Your S-corp actually gets a deduction for that $50,000. So your K-1 will show $50,000 of income, and then your W-2 will show $50,000 of income. So your tax return will still show $100,000 of business income. It's just separated between a W-2 and a K-1. The difference here is that the K-1 is not subject to employment taxes, so that $50,000 does not have any employment taxes at all. You're only paid employment taxes on the W-2, and those employment taxes are paid with the employment tax returns. When you're a sole proprietor or a partnership, the self-employment taxes are assessed on your 1040. So the 1040 amounts due can be really, really high. But as an S corporation, all of that is paid with the payroll tax returns. And so when you get to your personal return, there's no self-employment tax to pay because that got paid with the employment tax returns. And if your salary was $50,000, the employment taxes on that was about $7,500. So that $50,000 that you're receiving as a K-1 is not subject to employment taxes, and you've now saved yourself $7,500 that year alone in employment taxes. If you own an S corporation for 10 years, that's $75,000 in tax savings over that 10 years. Now there is a little bit of a warning that goes along with that, and that's if you're limiting your salary and reducing that down, there will be less credits going into the Social Security system, so that when you go to retire, your Social Security benefits could be reduced in that sort of a case. So it's important that if you're saving $7,500 a year in payroll taxes, that you don't go and just spend that somewhere. It's wise to say, okay, I saved $7,500 in employment taxes, I'm going to put that into an investment. Maybe you put it into an IRA or a Roth IRA, or you put it into a savings account. You put it somewhere that it's going to earn and make you money so that it's there when you retire, and it will supplement your reduced Social Security income that way. So that's the big difference of S corporations. Finally, we have the C corporation. C corporations tend to be the worst way of doing business because they are subject to 2 levels of tax. So a C corporation, it pays tax itself. So some clients say, well, I only want to pay tax on the money I take out of my business. And that's how a C corporation works. You personally are not taxed on the money a C corporation makes unless you've taken that money and taken a dividend out of the C corporation. However, in order to make that happen, the C corporation itself has to pay tax. Currently, C corporations have a flat tax of 21%. So if a C corporation makes $100,000, it will be taxed at 21% on the federal plus whatever might be taxed on the state side. So it immediately has to pay $21,000. So now you're down to $79,000 that you can distribute. If you then decide you want to distribute that whole amount to you, guess what? You pay tax on that $79,000. So the income ends up being taxed twice. C corporations file a Form 1120. There's no K-1s or anything because there's no income that comes to the owner. There's no flow-through income. You'll just get a 1099 dividend from that C corporation if you take a dividend out of that, or a 1099 div that comes out of that C corp. So those are the types of entities. C corporations are beneficial in certain situations. Sometimes if you're getting an investment, say from like a private equity fund or something like that, sometimes they require a C corporation because they don't want to see the flow through, so you've got to turn into a C corporation for that. There is a very special rule to C corporations that is very rarely applied, very rarely happens. But if you own C corporation stock for 5 years and then you sell that C corporation, there's a way to get tax-free treatment on the sale of that stock. And so, you know, if you're starting a business and you expect to sell it 5 years from now and you hope that you don't make a lot of money over the next 5 years, but you somehow plan on selling that for a really large amount in 5 years, a C corporation might make sense there. Listening to other professionals and things, they typically even don't recommend it in that situation because you're going to pay double tax all along the way. And depending on what that exit strategy looks like, it may or may not be beneficial or helpful. But anyway, you know, wanted to mention that because that is a major advantage to C corporations, an advantage that's only available to C corporations. You can't get that. It's called 1202 small business, qualified small business stock. It only applies to C corporations, but very rarely do we see that applied, at least in the clients that I've worked with. So that's an overview of our entities, how they work, how they're taxed, and I hope you find that helpful. Thank you so much for taking time to watch this video. If you enjoyed it, I hope that you hit the like button. If you haven't subscribed, please subscribe as well. We have ways to learn more about taxes than inside this video. We actually have a weekly newsletter that we send out. You can sign up for that at taxtutor.com. We also have a school community where we interact with business owners. We answer questions, we give training and give other support there. We have an online course that's part of that community. So if you'd like to join our community on school, you can do that also at taxtutor.com.